Yo, what's good, YouTube? So I'm just gonna do a quick rundown of some fundamental analysis that we should be doing on stocks that we're looking to buy, just so you can get a good feel for the company. And for this video, I'm gonna be doing one on Ford, just because it's been a pretty hot stock lately. It's been going up pretty nicely. And so basically, what I want to do first when I'm gonna check out a company is I want to check out the chart and see where it's at in terms of all-time highs. We see that Ford getting close to an all-time high, but it's not quite to where it's been before. And honestly, I'd prefer that there hadn't been a past all-time high up here. I prefer that it just be consistent growth from when the company first went public all the way to now, because this tells me that there's been hype up here in the past and then it's dropped back down, so it could do that again. But this by no means means that Ford isn't going to keep going up for the rest of its lifetime. You know what I mean? But it's just I prefer to just see a consistent trend upwards. And the next thing we want to do is look at the market cap and the PE ratio, and the earnings per share is helpful too. But the market cap and the PE ratio are really what you want to be looking at. And so basically what a PE ratio is it's the price to earnings ratio. And so it's the price of the stock of this one piece of stock right now divided by the earnings per share. And so we see that 0.71 goes into 34 times apparently. But the way that they get that is they take the full value of the company that the market is valuing it at. So it would be 97.76 billion. So that's the full value of the company, and then they would divide it by the full net income is what they use. So they divide 97 billion by the most recent net income, and they would come up with 34.31 as well. And so what we want to do after we get these numbers just in our heads, we go over to the financials. I mean, this is like the chart right here. You can get a better view of the chart using this, but it's not super important if you're not trading. I mean, it is important, but the this doesn't really give you like a feel for how the company is doing fundamentally. It just tells you what the market is valuing it at. There's plenty of companies that have terrible fundamentals that the market props up a whole bunch. So here we go to the income statement. We see total revenue, cost of revenue, gross profit. Those are three important things. And we want to look at net income from continuing and discontinued operations. That's what they would divide the company's market cap by, this number right here. But revenue is also nice to look at, cost of revenue, gross profit. So we come over here, we see from 2018 to now 160, 155, 127, 134 billion for total revenue. And then the cost of that revenue is pretty high, 136 billion, 134 billion, 112 billion, 115 billion. So we see the total profit they got 24, 21, 14, 19. We see more operating expenses, so then operating income, this would be the gross profit minus the operating expense. We see 7 billion. We come down to net income from continuing and discontinued operations, and this is after all the other expenses that come with their profits. And so net income went from 3.6 billion to 47 million to negative 1.2 billion, and then the most recent trailing 12 months is 2.8 billion. So you'd rather just see consistent growth upwards. You don't really like to see this kind of fluctuation, but the entire market's been weird lately with COVID, so it's kind of understandable, but you would like to see consistency in this. But net income really isn't the most important thing. The most important thing is cash flow, but we'll get to that last. But now we go to the balance sheet. The balance sheet is also important. It can tell you how much cash a company has, how many assets, and how many liabilities they have, and how much debt. So we just get those all fleshed out. And so we see total assets stayed pretty consistent for the past 3 years. Cash stayed consistent as well. in cash equivalents. So we see 14 billion in cash, 267 billion in total assets. So ideally they'd have less debt than they do cash, so that if push comes to shove, they could just pay off all their debt right then and there. And you'd like to see that they have more assets than liabilities. So we come down here, we see that they have 30 billion more assets than liabilities. Debt isn't showing up right here, but it should show up at the bottom. So we see 14 billion in cash, and we see total debt 162 billion. And it varies for different companies in different markets, you know what I mean? Like Ford is obviously a car company, so you can imagine that they would go into a lot of debt, borrowing materials for making their cars and whatnot. It's probably a pretty expensive type of business to run compared to, like, you know, a bank. I mean, banks are also expensive to run, but just like compared to maybe Kroger or something like that, where they're not building, you know, assets worth thousands of dollars, not building product worth thousands of dollars, you know what I mean? So they obviously have to spend more money in order to make their product. And so we see current debt at 51 billion, and see if we can find the long-term debt. Long-term debt 111 billion. So there it is. I couldn't find it at first, but see total debt. So obviously that's current debt plus long-term debt, 162 billion. They have 111 billion in long-term debt, 51 billion in current debt, and only 14 billion in cash. So that's really not great, you know. It's an easy way to go bankrupt. But I mean, obviously it depends on the company. Like banks will have a lot of debt compared to cash generally, and so on and so forth. And then cash flow is really the most important. You want to see consistent growth in cash flow, definitely, because that's, at the end of the day, that's different than net income, because there can still be expenses that come with that. But net cash flow, free cash flow, is just how much money is either coming into the business or going out. So we see that in 2018, $7 billion. At the end of the day, at the end of the year, they made $7 billion in profit. And then 2019, they made 10 billion. And then 2020, they made 18 billion. In the trailing 12 months, they've made 11 billion. So $11 billion have come into the business in the last 12 months. And so this is how we want to, the number that we want to use to calculate the intrinsic value of a stock, because net income after operating expenses and whatnot can be manipulated more easily than free cash flow. So free cash flow is really what you want to judge a company's profitability by. So we take 11 billion, that's our most recent one, our most recent free cash flow. So 11 billion, and then we see a market cap of 97 billion. So if you were to buy the company right now, and just for example's sake, clarity's sake, we just assume that the earnings from the trailing 12 months won't go up. So you buy the company now, and then for the rest of the company's lifetime, it's just going to make $11 billion per year. So if you bought it for the valuation that the market's giving Ford right now, it was making $11 billion per year, and you bought it for 97 billion, it would take about 10 years to make your money back off of Ford, which is actually a lower PE ratio than what you get basing your valuation off of net income. So we see that they had a net income of 3 billion and a market cap of 97 billion. So obviously 3 times 33 is about, 3 times 33 is 99. So about 3 billion times 34, it probably lands somewhere around 2.8 billion times 34. Obviously lands on 97.64 billion. But if we go to the free cash flow, we see that their net income from business operations actually wasn't the total amount of money that they made in the trailing 12 months. They actually made 8 billion more on top of that. So you want to be cognizant of the fact that net income is more easily manipulated than free cash flow, and free cash flow is really the way you want to judge whether or not a company is profitable or not. And what you really want to see is consistent growth in the free cash flow. And so to do that, we can go over to gurufocus.com, and we see the free cash flows down here. We see the last year's free cash flow increase of minus 33%. So we can go back and check that against what we actually see. And if I recall, the year before was 18 billion in free cash flow, and the last year was 11 billion. So it has dropped significantly, about 30%. So that makes sense. For the last 5 years, it's grown at 7.3%. For the last 10 years, on average, it's grown at 11.8%. So when calculating intrinsic value, we would want to take the most recent trailing 12 months free cash flow and multiply that by 11, and find out what 11.8% of that is, and add that onto the free cash flow of the trailing 12 months in order to estimate what our free cash flow will be next year. Then we do that until 10 years out, and whatever we can sell the business for after 10 years into the future, plus those 10 years of free cash flow calculations, is what the intrinsic value of the company is. But so basically, when you're first looking at a stock, you want to figure out how much money it's making on average, what the growth rate of that income is, how much, and you want to see if the company is overvalued compared to the amount of money it's making. And really, a good valuation for a company is that if you were to buy the company today, could you make your money back in 10 years? That's about a 10% return on investment. It'd be better if you can make your money back in 5 years. That would be a 20% return on investment, and so on and so forth. But the lower the PE ratio, the better return on investment you can expect to get. And but obviously, PE ratio isn't the end all be all. It's more of whatever the market cap to free cash flow ratio is, I guess you could call it, which is really what the intrinsic value of a company is. But yeah, that's just what I look for when I'm first checking out a stock.